Good morning, everyone. Welcome to Morning Markets on Wednesday, the 4th of March. A couple of things that I think you'll find interesting from our discussion at our morning meeting today. The first, we focused on the surprise interest rate reduction from the US Federal Reserve, where they reduced interest rates by 50 basis points. This is the first time in a decade that they've taken the decision to reduce rates intra-meeting. Their March meeting would have been happening in 10 to 12 days, I believe. Why did they do this? I think there are a couple of reasons that we've discussed in previous morning markets. One being that they have flagged that they would take the appropriate action that would be required. And we obviously discussed yesterday the G7 finance ministers meeting and central bank meeting that was happening yesterday morning. They came out of that and they've thought the right course of action is to reduce rates by 50 basis points. Interesting to note the market reaction in the US, where the equity market was weaker post the announcement, but the bond market continued to strengthen. So again, speaking to the need for thinking about diversification when you're constructing a portfolio, that relationship or the negative correlation between equity and bond markets continuing to hold. I think the other thing that's worth noting in that regard is why reduce rates? Well, one is to improve financial conditions. We did see financial conditions start to tighten a little bit in the US. Clearly, by reducing interest rates, that is supportive of less restrictive financial conditions going forward. And ultimately, there is a lag between the time that interest rate reductions occur and their impact into the broader economy. It's also worth noting that equity markets in other regions of the world neither experienced the euphoria that the US saw on Monday, nor have they declined to the same magnitude as the US did yesterday. So a bit of travelling arriving with the US market in that regard. The other thing that we discussed is the number of data points that are coming out from China, which look at economic activity through February. I think I would caution that actually putting any reliance on this information is probably futile, given the dynamics that we saw in the Chinese economy with the impact of the coronavirus and the basic shutdown of the economy through the Chinese New Year. So I would really caution everybody to try and not focus on that information, given the dynamics that we saw in the marketplace. I'm sure that you'll see headlines around Chinese car sales and things like that as to how they have deteriorated. Just kind of don't ignore it, but try and look through it and remember the context from which those data points have come. The final discussion that we had today centred around the UK. We've touched on some of the economic indicators that we've seen coming out of the UK post-election, where it's observable that there has been an improvement in sentiment. What did we see today? Well, we saw an improvement in the construction PMI, so that related to housing and construction, which again increased further from January. So again, another highlight that there is change within the UK economy. It's yet to feed through into the hard data, but we're definitely seeing survey evidence of improvement in the UK economy post the election victory of the Conservative Party, and that feeding through into confidence. Interesting to think then and contrast that positivity with how sterling has performed over the past couple of weeks, and also how the broader UK equity market is performing. So that's something that we're continuing to discuss and something that we'll come back to in future discussions in these morning market sessions. Many thanks for joining us today, and I look forward to seeing you again tomorrow.